Let's compare investing in shares and investing in real estate investment trusts. The two are similar, yet they are different. So that's why I'm doing this video, just to help you have a better understanding of how they operate. First of all, when you're buying shares, you're owning part of that company. You're becoming an owner. And by shares here, I'm talking about you buying shares in companies that are publicly listed. So these are shares in companies that are listed in the Nairobi Securities Exchange market. They are publicly traded. They are open to anyone who has access to that market to be able to trade. For REITs, actually REITs are companies that operate, manage, finance, or develop real estate, income generating real estate. So these are companies. You're not owning the shares directly, but you're owning part of this company that is managing these assets. So yes, you're investing in real estate, but you don't have a share in terms of the real estate property. You just have a share in the company that is managing this real estate. Those are real estate investment trust. In terms of how you make money, it's the same. You can make money through dividends. Let me just do this calculation. So let's say you have 50,000 Kenyan shillings and you want to invest in shares, you want to invest in REITs. So for REITs, I'm going to refer to the share as a unit. For shares, I'm going to refer to it as a share. Okay. So you have 50K. I'm going to assume that we have company A, we have company A, and we have company B. And the price of one share, the price of one unit is the same for both of them. It's 20 shillings. So you want to buy shares. For example, you want to go and buy shares in the Nairobi Securities Exchange market for a company like from a company Safaricom. So let's say the price of Safaricom shares is 20 shillings. It's actually not 20 shillings. It's around 18 right now. But let's just assume for this example, let's assume that the price is 20 shillings. So you go to the Nairobi Securities Exchange market and you buy a share from Safaricom that is going for 20 shillings. Or you go to one of the real estate investment companies here in Kenya. There are actually quite a few. We have Elam. There's one that is managed by ICA Lion. There's one for VUCA Investment Club for Akon Holdings. And there's also another one. I can't remember, but there's also another one that is listed in the NSC. So as you can see, we don't have many REITs in Kenya, but we have many publicly traded share companies. So let's say that you go to one of the three that I've mentioned and the price of their unit is 20 shillings. So it's quite the same. You have 50,000 Kenyan shillings, the same price. So if one unit or one share goes for 20 shillings, how much or how many shares or units will you be able to buy with 50,000 Kenyan shillings? So you divide the two, you'll be able to buy 2,500 shares, which is 2,500 units for real estate investment trusts. Assuming that this company, in this case, we are assuming Safaricom, pays out a dividend of 0.8 shilling per share, which is also similar to the dividend payout from the company, or rather from the REITs company, from one of the REITs company, is also the same. So with 2,500 shares times 0.8, you're going to make 2,000 shillings as dividends. This is dividends. So we take away the tax, which is 5%. You're going to remain with 0.95. This is 100% minus 5% tax. So I multiplied this directly. I'm going to make 1,800 shillings from the shares that I bought at Safaricom. Assuming that I had bought units in this real estate investment company, real estate investment trust company, I'm also going to make 1,800 shillings. You can see that they work in a similar way in terms of the dividend payouts, in terms of you buying shares or you buying units. The other way that you can make money from both of them that is quite similar is in terms of dividend, or rather it's in terms of capital gain. See, when you're buying a share, in this case, you're buying a share from Safaricom, you are expecting that the value of this company or the value of this share is going to go up. Because if it goes up, you can actually take advantage and sell your share. It's also the same thing when you're buying a unit in a real estate investment trust. You're buying it now so that the value can go up in the next 2 years, in the next 4 years, in the next 5 years. In this example, I'm going to assume that 3 years later, the value of this share, the Safaricom share, is now 24 shillings. Or the value of the unit, one unit that you bought in this real estate investment trust, is 24 shillings. So if you bought a share or a unit when it was 20 shillings and now it's 24 shillings, you have gained by 4 shillings. So this is our capital gain. It's 4 shillings. The share or the rate was 20 shillings. Now it's 24 shillings. And there's that gain of 4 shillings. So you can decide to sell your shares or to sell your units. Actually, if the price goes up, there's that high chance. It's actually a probability that the value has gone up. So it's going to be attractive. So probably somebody might want to buy this share. In this case, you sell to them. And you decide to sell the number of shares or units that you bought, which were 2,500 shillings. So 2,500 times the 4 shilling that was the capital gain, you're going to make 10,000 shillings. This is just the capital gain. This is not the amount of money that you're going to make from those shares in terms of you selling. This is not the selling price. This is sort of like the profit, because I've subtracted this directly here. So this is a sure bet. Now, one interesting thing is that there is no capital gains tax here in Kenya for companies that are listed in the Nairobi Securities Exchange market. So you're going to make these 10,000 Kenyan shillings at the end of the day. It's the same thing for REITs. They are not taxed. They are exempt from capital gains tax. So this 10,000 Kenyan shillings that you've made is the actual amount of money that is going to be deposited in your bank account. This is a good thing. So you can actually take advantage of the taxes. In terms of dividends, it's 5%. Unlike with other investments like mutual funds where they're usually taxed 15%. So you can see there's that tax difference. And also there's no tax in terms of you gaining. This type of tax is usually imposed when you're transferring a piece of property. This is in terms of the calculation. So you can see that they operate in the same way in terms mathematically speaking, but there are some differences. There's some differences that we can't overlook. The first one is in terms of dividend payments. You see, when you're buying shares in a company that is listed in the Nairobi Securities Exchange market, it's not a guarantee that that company is going to pay you dividends, because the company can sit down and can decide, yes, this year we made profits, but we want to focus the profits elsewhere. We want to expand more, and we are not going to be distributing any profits in as much as the company is profitable. So yes, they have the ability to pay dividends because they made profits, but they're not going to pay you profits. That is in terms of shares. But for REITs, the law mandates that all REITs in Kenya must pay more than 80%. I think it was at least 80% of the net income that they make. Net profit. So it's actually a must that you must receive dividends from your REITs company, from your REITs shares, from your REITs units. It's a must. In that sense, dividends in REITs are regular. They are a must. You must make something every single year. But for shares, it's not a must. It depends with the company and how they're planning to structure their profits. The second difference is in terms of where the companies are listed. Both companies are listed in the Nairobi Securities Exchange market. So if you want to buy shares that are listed in the NSE, or rather they are listed in the NSE, in the main market. So if you have access to the market, that is, you have a CDS account and you can log in with your stockbroker, you can actually view all the companies there, and you can decide, okay, I want to invest in this company. And you can get to select the company that you want to invest in. So it's actually in the main market. It's something that anybody can see. REITs are also listed in the Nairobi Securities Exchange market, but they are not open to the members of public to trade in. They are quoted in a market known as, okay, should I call it quoted? In the unquoted securities platform that is within the Nairobi Securities Exchange market. So this one is not open to the members of public. It's restricted to the people who have access to this platform. Remember, with shares, anyone can actually go there and trade. But this one, not everyone can go there and trade. There are certain restrictions in terms of these companies deciding how many units can be sold. There's that dynamic. Remember, with shares, you just go there and you select the companies that you want. So you can decide to have a basket of, okay, I want a basket of Stanchart. I want a basket of, I want my basket to be full of a little bit of the agricultural sector. So I'm going to add Williamson tea to my portfolio. I'm also going to add a bank like Stanchart, like I mentioned. You can also decide to go for a telecommunication company. But with REITs, you are investing in one company that we surely know is in the real estate industry. So the industry is one. That's why the platform is actually limited, because this company can decide that, okay, these are the number of units that we want to sell. So you have to identify the real estate company that you want to go for, that you want to invest in, and they are going to guide you on how you can actually trade your units. It's not something that is openly traded. The other difference is in terms of liquidity. Like I said, shares are publicly traded. As long as you log into your portal tomorrow at 9, it's usually at 9 a.m. to 3 p.m., you can freely trade. You can freely sell your shares as long as there's demand for that share. As long as there's supply for that share, you can actually trade. It depends with the market. But here we have restrictions. You just can't buy or sell your units any single time, or any time that you feel like you want to sell it. You'll notice that for these REITs companies, they usually have a specific day for trading. They can decide to say, okay, maybe once a month we're going to be trading. We're going to have an open market rather every once in a month or twice in a month. The other difference is in terms of volatility. I'm talking about the price of the share going up and down, up and down. Shares are very volatile. The price can go up, the price can go down, the price can go up, the price can go down, depending on different things, depending on what's currently happening. Do we have political tension, or is the political climate good? Do we have legal implications? Do we have a certain law that is going to affect this? Or has somebody powerful, a powerful businessman, tweeted about something? Like, we have those things that affect this industry. So the price can go up and down quickly. Today, the price can be 20. Tomorrow, the price can be 200. The day after that, the price can be 13, depending on those dynamics that I've talked about. But with REITs, yes, there's that influence, but the influence has to be directly on real estate. We're not talking about different factors affecting this. Like here, we're talking about a specific industry. Whereas for shares, we have so many factors that can affect this. Of course, here we have the same issues like what about legalities and all that. But the way the price goes up and down is not the same as how the price goes here. And we know that the value of real estate has always gone up. Yes, it might be slow, but it's not as volatile as that of a share. The other difference is in terms of ownership. Like I said earlier, for shares, you are an owner in that company, depending on the number of shares that you have. You can be the majority shareholder, but for REITs, you don't own that real estate investment property. You just own a unit of the company that is managing that real estate investment property. One last thing, if you're going to invest in either of the two, think about capital appreciation. Think about the value of this share going up. Think about patience. You're not going to invest today. You're not going to buy shares today and you make millions tomorrow. It might work. But these types of investments are not short term. If you want to access your money easily, anytime, don't invest here. Here, we're talking about medium to long-term investors, people who are thinking about 2 years, 3 years time. In fact, If you don't have an emergency fund, if you don't have money to protect you, to save you in case of an emergency, don't put your money here. Build an emergency fund first, then think about investing here. Thank you for watching. Like this video and see you in the next one.